Welcome to Real Estate Agent Superstars. I'm your host, RJ Baxter with Intercap Lending. And today I've got an awesome superstar guest. I have Jay Holland from listings.com. And Jay is joining us to talk about his unique model in the real estate industry, how he got into that niche, how he does it. Jay is focused on investment properties and helping investors build wealth over time and finding the right properties. And he also has a property management arm to his business. So we're going to get into all that and more. Welcome to the show, Jay.
Thank you, RJ. Appreciate it. Thank you for having me.
Yeah, great to have you. So tell us a little bit more about yourself. What's your background? What did you do before real estate?
So I guess mostly what I did before real estate, I was in the Marine Corps for 5 years. I enlisted, did a year of college in Florida. Thought college wasn't for me at the time. Joined the Marines, got stationed originally in California and then over to Okinawa, Japan, spent some time in Australia. And then my last duty station was in Denver. And decided to get out, didn't want to make it a career, and did a few different things, did recruiting for a little bit, for a few months, and worked at a technology company for a few months, and finally decided that real estate was something that I was interested in and wanted to pursue. I had some family in the real estate industry, my cousins, my dad back on the East Coast where I grew up, and fell in love with Colorado. Decided to stay and just kind of jumped into real estate full time back in 1999.
Okay. And did you right off the bat? Did you have this idea to focus on the investment side of things?
No, not really. So, I got into real estate just like everybody else, I think, primarily does, to help buyers and sellers with their primary real estate needs. And what that kind of evolved into, because of the connections that I had when I first started my real estate practice, was working with some veterans. So I had the opportunity to help some of the folks that I knew from the base where I'd worked previously. And a lot of those guys that bought houses with their VA loans, they got orders to go get stationed in other places in other states all around the world and the U.S. And the equity at that time wasn't growing as rapidly as it has here in Colorado over the past decade. So maybe back then in 2000, 2001, the houses in Colorado were appreciating at 1 or 2% per year. It was a kind of stagnant market from an appreciation standpoint. So what happened then is, these guys that did their VA loan, and as you know, you can finance your funding phase. So you're getting basically 100% financing. Then you've got your, if you're looking to sell your house after a couple of years, you have your real estate commissions and your title insurance fees and your property taxes and things that sellers normally pay here. So even if I offered to do it for free to help out a friend, they were still upside down. So the kind of the goal at that time was, hey, why don't, the market's doing well, it is appreciating, but it's only going up a few percentage points. We need it to go up more before, you can sell your house and not have to come out of pocket. So why don't we try to rent it for a few years, let that appreciation grow. And if the rent covers your payment, then, you're in a better situation than having to write a check for $10,000 to sell your house. So that's kind of how the property management business was born, back in the early 2000s, just to help out those folks that were veterans and not having enough equity in their house to be able to sell. So at that time of my career, I was with RE/MAX Southeast, and we devised a property management system that allowed us to, manage property, underneath the RE/MAX umbrella, which nobody had ever done before, and not in Colorado.
Okay. Was that something that a lot of people at RE/MAX were using, or you just mean your team?
No, I mean, we invented it. So we were the first ones to do it. And it really wasn't a thing that, that RE/MAX brokers did back then. Property managers were like a separate thing that they only did, most real estate agents, most realtors just did sales. And there were a few property management companies in town that really only focused on, property management, and not many people did both. So it was a new concept for RE/MAX. We had to get it approved all the way, up to the top level. And once we got all the pieces in place, they said, "Yep, go ahead and you can start doing this." So,
okay, interesting. So take us back to that era. When did things start to take off in Colorado as far as the market goes with appreciation?
Yeah. So as you know, we had a huge run up before the crash, so to speak, and once I think it was Clinton was president at the time. He passed a couple laws that allowed easier access to financing. There were a ton of programs out there for seller-assisted down payment. We had the neighborhood gold stuff back then. All the you could write a contract at 110% of the list price, and the seller could pay 3 or 4% in closing costs and 6% or 7% in a down payment, and you could basically buy a house with no money down back then. And you probably remember from I think the movie The Big Short did a lot of pieces on this, but you could literally walk into a house with no job, no income, no assets, and just sign your name and buy a house with no down payment. It was ridiculous. So many people were doing that, and that caused prices to run up. And so we had a ton of appreciation happening in the market, which was probably a little false due to the lending conditions. And then, of course, 2007 happened and 2008, and then we started seeing some foreclosures and some investment opportunities. And really from that point is when I kind of looked at the market with several of my clients who were very interested in buying distressed assets, buying short sales, buying foreclosures, and turning those into rental properties. At the time, many of us were very bullish on the future of the Colorado market, on just the future of the Colorado economy, and getting into the rental property business was very attractive, especially with the opportunities that the foreclosures presented. So underneath the RE/MAX umbrella, I was able to help investors kind of purchase those properties, and then we would find tenants to live in those homes, and then we do property management. We became more of a one-stop shop kind of during that era of helping investors identify good properties to buy that would make good rentals, helping them buy those rentals, and then transitioning from the sales agent once that transaction was completed to the full service management, where we would place tenants and then do full service property management. So it really grew out of that, pretty substantially.
Did it grow organically for you at that point, or were you doing some things to attract clients?
Yeah, no, it was mostly organic. I mean, we did a lot of business by referral, of course. We didn't have any kind of direct marketing out there saying, hey, this is kind of who we are and what we're doing. And we really still don't. Our business today, almost 20 years later, we're still mostly business by referral. We help our current clients grow their portfolio. We do a lot of 1031 exchanges where they're selling one asset that has a bunch of equity and rolling that equity into 2 assets or 3 assets, and then leveraging those up to, instead of owning 1 property, you own 3 without coming out of pocket, because you're just leveraging up the equity that you currently have. And you can do that tax deferred with that 1031 exchange. So we do a ton of those. And right now we're managing just under 400 homes. We've sold almost all of those to our investor clients. We do get some clients that get referred to us that come to us with a portfolio where they say, hey, I've already got 5 properties, I've already got 4 properties, and I'd like you to look at managing this and then also help me to kind of grow it out and build it and continue to acquire and make it bigger.
Okay. What kind of challenges do you see trying to manage 2 businesses, basically?
Yeah, I really lean on my employees. I've got a great team. We have 16 full-time W-2 employees now. We have had a little bit of turnover the last couple of years with just COVID and the market and everything that's kind of happened, in the country. But our core group, we have employees that have been with us for 5 years, 7 years, and of course, my fiance Stacy, who's licensed, she really runs the operations of the property management side. So she's absolutely amazing and kind of keeps that business really trucking along at full speed. I can focus more on the acquisition side and do the sales for the team and do a little bit more client development. And she can kind of run the day-to-day operations of the employees, as well as all the things that come with property management, maintenance requests, rent collection, construction projects, those type of things.
Okay. Are all 16 on the property management side, or do you have some on the real estate side too? As far as
just one employee that works on the real estate sales side. Kara's our transaction manager who handles all of our listings and sales when we're buying property or selling properties. She does all the transaction coordination, and she runs the contract calendar and schedules the inspections and does all the normal transaction stuff. She's also licensed as well. so she can help, in a higher level function of someone who, isn't a licensed, assistant.
Okay. Do you have other licensed agents that work with you?
Yeah, actually, so we've got a great team of licensed agents. A couple of our leasing agents actually have real estate licenses, but just strictly on the sales side, I've got a phenomenal agent, Jordan, who he lives in Pueblo now. It's where he grew up. He was in the Denver market for a while, and he went to the Breckenridge market for a while, and now he's back in his hometown of Pueblo. He's
Mhm.
instrumental at helping us acquire new properties. Because of the sales conditions and the rental conditions that we've experienced in Colorado over the past, really decade, we've had to expand our business and expand our portfolio north and south of the Denver metro area, and primarily south. The Colorado Springs has been a phenomenal market for return on investment, and the Pueblo market is also a very strong market for return on investment. And having Jordan there, as a full-time agent, with all the connections that he has from growing up there and living there, we really get an advantage to deals that are presented to us, as well as his knowledge of the local market there. So he's one of my top guys, and he's really helpful on the acquisition side of identifying and buying new properties for our investor clients.
Okay, nice. So walk me through how you identify properties. What's your process? What does that look like?
Yeah, so we look at deals from all sources. So we have connections with wholesalers that present us deals. We have connections with other agents who are out there, going on listing appointments, and they get to a house and they're like, "Ooh, I don't think I can sell this. It's a little distressed, structurally or cosmetically. It might need some work." And or the seller's got a situation where they need to sell quickly because of a personal situation, a divorce, or bills that are piled up and things like that. And those listing agents, because of our relationship and our network, will actually call us directly and say, "Hey, I've got a deal. Maybe your guys might be interested in this one." Of course, we have multiple listing service, the MLS, so we can see every property that's listed. And our first step is we typically, on paper, using the online resources that we have, we look at what we think it might rent for, what we think it might be worth from a sales perspective, using the expertise that we have and the tools that are available to us as realtors online. And then we'll go out and get physical eyes on the property. We'll walk the property, kind of do like a really thorough walkthrough. Not quite an inspection yet, but we'll with the 25 years experience that we have, we know what to look for. We know how to identify issues that are going to be critical to making sure that the investment's profitable. And once we get eyes on it, we've run our numbers, on the back end, we can go ahead at that point and make an offer and try to secure that property with a contract. We do write all of our contracts assignable because at that moment we don't know, which investor that property might be a good fit for. So, we basically write it assignable. Usually it's in, my name or one of my entities that we own. And we'll get the property under contract at that point. We'll go through a formal inspection, start the financing piece so we can get an appraisal ordered. And then during that first 10 days, we will present it to our investor clients who are kind of waiting for the next deal. And some investors say, "Nope, this isn't the right one for me. I'll wait for the next one." And then, eventually we get down to an investor who, down the list, so to speak, that'll say, "Yeah, this is great. Let's go ahead and do it." I'm always the last guy at the end of the line, so I don't cherry pick deals, for my clients. If I did that, I'd be a retired real estate investor, not a real estate broker supporting their needs. So, but I'll never write a deal that I don't believe in myself. So, if it's just not a good time for everybody who's on our list for one reason or another, then I do get to buy that one. And over the last couple of years, we have been able to add a few, personal deals to our portfolio, but, those are the deals that we offer to our investors first, and they don't, for one reason or another, decide not to pull the trigger on.
Okay. How big of a list of investors do you have?
It fluctuates, at any given time, we at least have a couple, I'd say 3 or 4 probably right now with the way the market conditions are. As you know, as the world knows, unfortunately, these are the highest interest rates we've seen in 27 years. And maybe longer, but that's the stat I read last week. So, financing is a big component of purchasing these investment deals for most people. Most investors don't buy with all cash. most investors see the power of leveraging and putting a mortgage on a property that they're going to be renting out and letting the tenants, pay that mortgage down. There's many, many advantages to doing it that way. Also, you can, if you had a fixed amount of money, if you had $300,000 to invest, you could buy 3 properties with $100,000 down each instead of, one property for 300, in cash, right? So, and now you've got 900,000 or $1 million in the marketplace versus just 300,000. So leveraging up is a great tool. The problem right now with today's world is that, at 8 or 9% par interest rates for investors, it's a terrible return, when you look at the numbers comparatively to what it was just a few years ago. And, I've looked back, recently because of where the interest rates are now to kind of see historically where they were when we started. And, we were doing investment deals in the 2009, 10, 11 range that, investors were getting rates at 7-8% back then for investment property. And then obviously 10 years later, 12 years later, they're getting investment rates at 4% or 3.5% on investment property. And now, of course, they're up in the eights, with buy downs, right? They're not even at 8 at par right now. So, I mean, you tell me, that's your world. But so to answer the question, I guess, how many guys do we have on our list at any given time? When the market was favorable with interest rates, we had 15, 20, 30 people saying, hey, find me a deal, I'm ready to buy it. And, currently right now, we probably have 3 or 4, serious investors that are like, if you find me a good deal, pull the trigger. And obviously with the rates the way they are right now, we're not finding as many good deals. There's not a lot of inventory in the market. As everybody knows, it's a very constricted market as far as inventory. We've got almost the fewest houses on the market that we've ever had right now. And that's likely due to the interest rate world.
Yeah. So how have you identified properties then in today's market?
So we're still seeing the same, sources that we've always seen. There's always, unfortunately, there's always divorce, in the world. Unfortunately, there's always, people that pass on and move on. And, so we're seeing a lot of estate sales, and we're seeing, the same number of divorce sales and estate sales are currently in the market. And those can be distressed assets. Those are folks that are motivated. Sometimes the properties aren't, cosmetically, the best that they could be. And so those, that flow of properties hasn't really, been interrupted. But the kind of the normal cherry picking deals, through the normal MLS and resale is definitely a lot harder with the lack of inventory.
Yeah. So it's difficult in this market to identify properties that make financial sense, is what you're saying.
Because of the interest rates, absolutely. Like, if we look at 10 deals today, a year ago, all of them would have made perfect sense. 2 years ago, all of them would have made perfect sense. Maybe one makes sense now with the way that the interest rates have adjusted to the current market. So it's mostly on that platform. And what a lot of our savvy investors know is that if they can get into a good property now at a good purchase price, and then that's the other thing with the way interest rates are right now, our buyers aren't competing against 40 other buyers. They're not. They're not paying $100,000 over the asking price and waiving inspections and doing all the crazy things that happened, over the last 2.5, 3 years. Right now, it's more of a buyer's market. I wouldn't call it a full buyer's market yet, but I think we're moving that way. But the market is more favorable to buyers than it's ever been, going back 3 years. So we're able to get property at the right price point. And if the investors are savvy enough to realize that the mortgage world is temporary, and they, are confident that in the next 5 years to 10 years they'll be able to do a refinance and lower their payment on the investment that they buy due to the interest rates, dropping and being able to refinance, then they're not hesitant to pull the trigger and get into a deal that maybe last year would have made a lot more sense, and then this year makes a little sense, but a few years from now, it might make a lot more sense, and they'd be glad that they did it. So that takes an experienced investor to kind of see that big picture with the mortgage world, and someone that's been doing it for a while and has seen the fluctuations in the mortgage market. And you can tell a new investor, hey, this is what the market's done. This is what it could do. Nobody has a crystal ball, but here's the scenario. If it doesn't change, you're still locked in for 30 years. This is your worst case scenario. rents typically go up. Your mortgage likely won't go up if you're locked in for a 30-year payment. Obviously taxes and insurance can go up, but that's basically it. And the best case scenario is you can refinance, and now your 7% return becomes a 10% return, or your 7% return becomes a 12 or 14% return, with that advantage of a refinance. So the investors that have been in the market for a while and have seen the fluctuation in interest rates over time and understand that it's not a fixed constant, are still active in the market and looking for deals.
Yeah, and we're seeing that in the primary residence space too. People that are savvy and thinking about the situation, it's less competitive, so they're going after the properties now when they can get a better price, and then looking at that refinance down the road. So that's a really good point on that.
Yeah, if you're into cliches or I guess cute little sayings, they say marry the house, date the rate, right? That's what all the lenders are telling buyers right now. So it's true on the investment side too. I mean, when you leverage an investment property, you're typically doing a 30-year fixed mortgage. Some of our investors do the 7/1 ARM or a 7/6 ARM. You're looking down the road 7 years and locking it in for just that first 7-year period. But most of our investors choose the 30-year fixed route, and that rate's not. I've been doing this almost 25 years, and I've never known a person in 25 years that has kept their mortgage, that amount of time, right? I've never kept a mortgage that I've ever had. You probably have never kept a mortgage either. You're selling the property, paying the mortgage off. You're refinancing, changing the terms of the loan. You're not just making that payment, over 30 years, one at a time. That just doesn't happen in today's world. My parents did that. I'm sure my grandparents did that. But in today's world, it doesn't happen. Nobody makes 360 payments on a property without looking at upgrading their loan or refinancing when that opportunity comes around. So,
where do you see this market going? What's your forecast?
Thanks. Yeah. So short term, I think it is headed a little bit more toward a buyer's market. There's a lot of uncertainty in the inflation numbers economically in Colorado. I think we're still strong. We were awesome in Colorado before COVID hit and all the shutdowns. We were probably one of the top 2 state economies from an unemployment standpoint, in the country. And the thing about Colorado's economy is extremely diverse, right? We don't have all of our eggs in one specific basket, right? We have so many different industries that flourish here, and they're industries that usually have good, high-paying jobs, and those industries will continue to flourish. So I don't think economically we're going to have an issue, which obviously affects the real estate market. We have more people moving to Colorado than are leaving every year still. They're coming from higher priced areas. And even though Colorado prices are, really high, especially for the people that have lived here for 25 years or longer, they look at the prices and they go, wow. But we still have higher priced areas in the country that see Colorado as a discount and come here for the wonderful weather and the wonderful people and the way of life that is superior to almost every other place, in the U.S. And so that drives the real estate market, and that, with supply and demand, we still have really high demand here. The issue with the market right now is supply. We have what I call anchor mortgages, and I didn't invent that term, but it's thrown around in our space all the time. People that have currently a mortgage in the 2.5 to 3.5, under 4 fixed interest rate. Right now, for them to make a move, if they want to upgrade, or if they want to move closer to work, or if they just have more children, their families increase, and they need more space, or they want to buy a bigger house with a home office, or whatever, the things that people normally do as they grow in life, they're really anchored by that current mortgage that they have. Because for someone to even do a lateral move, if you're just moving from a $700,000 house to a $700,000 house across town to be closer to job or school or friends or whatever, the interest rate's going to almost double your payment from what you're currently paying right now. And no one's going to do a lateral move to double their payment. And then upgrading, you're tripling your payment, which most people can't afford to do. So, and that's just taking the equity you have in your current house and moving it over to your next house, and then just getting the same loan size with a much higher interest rate, right? So those anchor mortgages are really restricting inventory from coming onto the market. And people that are financially fortunate enough to be able to make a move, or if they're relocating for a job change and they are leaving Colorado because they got an amazing opportunity to move to some place where their pay is going to be much higher and it's or closer to family or whatever reason that they have, they're going to keep that asset. They're going to keep that primary residence as a rental home because rents are at an all-time high due to the due to the formula of housing cost. As prices go up, as interest rates go up, rents also go up. That's what happens historically. And so somebody with a 2.5% interest rate and their payment on their house is $2,500 a month, the rent on that house might be $3,800 or $4,000 a month for market rent on that same home. Or if their payment is $1,700 a month, the property could rent for $2,700 a month. So getting an extra $1,000 a month in income as your property continues to go up in value, as your mortgage continues to get paid down, now by your tenant, is an attractive scenario to a lot of people. So what that does is it increases, rental property to the market, which is, great for our property management business, but it's terrible for the real estate market in general because it's still restricting the supply of homes that are available for sale. And that's causing prices to go up because there's not a lot available for sale. So with the supply and demand, formula, we're looking at steady demand and limited supply. Prices go up, right? So that's kind of what's happening with the market right now. I think that demand is going to continue to dwindle. The demand goes down every time the rates go up. Demand goes down. So unfortunately, it's knocking a lot of people out of affordability. Home prices have gone up 27% in the last 5 years, and people's wages haven't gone up 27% in the last 5 years, and home payments with interest rates have gone up 200% in the past 3 years, right? So the cost of housing is extremely high right now comparatively, and that's going to limit demand. And once demand starts to be limited, that's when we're going to see prices kind of stabilize or maybe retract a little bit, where we're in a more of a truer buyer's market where houses are taking longer to sell, offers are coming in below list price, sellers are having to do price reductions, kind of like it was 20 years ago, 18 years ago.
Mm-hmm. What do you think it'll take to unlock the inventory problem we have right now?
Interest rates need to be below 5% par, and that's really going to be the number, I think. If you look at the average mortgage that's out there across the board, and your industry publishes a lot of stats on this, and they let us know what the existing average mortgage looks like. For people to make a move to be able to hit that affordability sweet spot, I think that our current market right now, especially in the Denver metro area, is like a bucket of gasoline, dumped onto a pile of kindling wood, and interest rates are either a match or they're a fire hose, right? And right now we've got really high rates, which is like just water on that pile, and if the rates drop below 5% par for purchases, the market's going to be the most ridiculous market we've ever seen in my lifetime, and probably ever. We went through the 2020, 2021 market where we had buyers lined up literally around the block to get into an open house. And, there were 40 offers on a house within 3 hours of listing with, 100,000 over the asking price, and throwing in my Broncos tickets and, everything else you could think of. I'll bake you a cake once a week for the rest of your life if you accept our offer. Just anything to be successful in winning that bid in a competitive bid scenario. That is going to come back, and it's going to come back worse because people that were participating in that market and weren't successful, they said, hey, this is too stressful. We can't handle this. We're sick of making 50 offers that aren't accepted. We're sick of looking at, 30 houses every weekend. Like we can't do this anymore. We're just going to rent. We're just going to pause and wait. And we see the benefit and the value of home ownership for creating wealth long-term, and everybody gets that. But they were so, stressed and distraught with the market conditions that they bowed out. And those people are really regretting, that decision right now. Most of them are, because they're seeing that they can't participate, in the housing market like they could have due to the interest rates being where they are. So if the interest rates drop again and give them that opportunity, they're definitely going to take advantage of it, whatever it takes. They're going to stand in line to get into a house. They're going to write those 50 offers again. They know that real estate is one of the greatest tools to create wealth and to create, generational wealth in the United States. And it's they're not going to let that opportunity, slip again. And then we also have all the folks that are just normally waiting in line to become homeowners that are priced out of the market right now due to interest rates. So if we see rates drop, at 5 or below, the market in Colorado is going to be the hottest sellers market we've ever seen ever. And it's going to be a frenzy, unfortunately. I mean, I don't necessarily like to participate in markets like that, but you have to help people to fulfill their needs. So,
well, one more question I have for you is, what advice would you give to other agents that are looking to succeed in the business? You've had longevity, you've been doing this for a long time, you've had a lot of success. What are a couple tips that you would give other agents?
That's a great question, RJ, and I do get asked that a lot, and my answer changes, day to day. So I don't know if you ask me this again next week, I may give you a different answer. But one thing that I can definitely say today is, you have to show up and you have to put the work in. You have to be available. Real estate is not a glamour industry like you may think it is because of HD TV shows and TikTok and Instagram and what people try to make it out to be. Just like any job that's sales based or commission based, where you're not guaranteed a paycheck, it is a 100% effort based industry, and you get out of it what you put into it. And if you work harder than anyone else, you'll get paid more than anyone else, and you'll be more successful if that's how you measure your success than anyone else. So really showing up and getting it done and not being a slacker, I guess, is probably the best tip I can tell like a new agent. Set your expectations correctly, and then it's a grind, but you got to grind, and the folks that do that are going to be the ones that come out on top in the long term. And the second thing that I would say to newer agents in the business is get a mentor. I was lucky enough at the very beginning of my career, I had a few good mentors that gave me some great tips and kind of set me off on the right path with with certain things. And having a mentor is definitely something. I think find a mentor that you can get advice from, that you trust, and that's willing to share, and that would also help you out if you're a new agent in the business right now.
Yeah, those are great tips, Jay. I mean, hard work trumps everything. There's no magic bells and whistles to propel your business. I mean, that putting in that sweat equity does it. So I appreciate you saying that.
Yeah.
Well, awesome. Well, thank you so much for taking the time to join me. I know you're super busy with 2 simultaneous businesses going and thriving in this market. And just thanks again for joining us.
Of course. Yeah. Thanks for having me. Love to come back anytime.
Cool. Well, thank you everybody that's listening too. My name is RJ Baxter with Intercap Lending. Please subscribe and share this episode. That's how the word gets out about us, and have a great rest of your day.